My name is Scott Myers. I'm the president of OptiFuel Systems. One of the things that we look at is the external threats that it may hurt us, such as regulations and competition, things of that sort. While regulatory drivers generally work in our favor, one key external threat is a market shift, specifically the potential transition of some freight shipments from rail to truck. If truck continues to capture more market share, the total number of locomotives in North America could decline from the current 38,000 units to about 30,000 over the next 20 years. Given that approximately 40% of freight, such as grain, crude, and automobiles, requires rail, this represents a worst-case scenario in terms of market contraction. Currently, transportation freight by rail is significantly more cost-effective than trucking. In the future, with the adoption of OptiFuel's locomotive technology, this cost advantage will be further amplified, greatly offsetting the threat of trucking. In financial terms, a modal shift of this size would reduce the total annual value of new locomotive sales in North America from approximately $7 billion to $5.5 billion. Our current projection assumes we capture 60% of the North American shares, which translates to annual sales of about $4 billion. Under this scenario of declining market, this would drop to approximately $3.3 billion per year when averaging over a 30-year period. It's important to note that these figures focus solely on raw locomotive sales and don't account for additional revenue streams from maintenance contracts, spare parts, and other services. Typically, the revenue generated from integrated logistics support for complex systems over a 20-year period can equal the capital value of the initial asset. Overall, while our market share toward trucking poses a challenge, our comprehensive approach and diversified revenue model helps mitigate this risk, assuming we remain well positioned for long-term success. Thank you.